If you've been watching my shows for the last couple of years, you know that I'm probably one of the most bullish people on cryptocurrency. And even when the markets go against us and we get some negative news, I always try and see the positive in the negative news. And so I consider myself probably one of the most bullish people in crypto. I think I've seen the light like many of us. And I really believe that this industry is one that's going to make us into millionaires and really make real change in the world. I did an interview for today's show with one of my VC friends, and I can tell you that the one takeout I got after this interview was, I'm not bullish enough. No matter how bullish I am, I'm not even close to bullish enough. Now, it's very rare that people take me out of my comfort zone specifically and say, you're not bullish enough. But at the end of this interview, if you watch this interview until the end, you'll realize that you're probably not bullish enough on crypto. Yep, you're not bullish enough. That's the message. So let's get going. You know, when I was younger, my grandfather used to say that I had optimist disease because I was the eternal optimist. And that makes me into a bull. I'm generally bullish. When I see something and I see the impact that this technology is making and I see the adoption that's happening in crypto, I'm generally a bullish guy. There's nothing I can do about it. And so I tend to hold on to good news more than I tend to hold on to bad news, which is in the long term not such a bad thing, because if you look at the technology, the chart of this technology, you can kind of see that if you're bullish, or if you have been bullish for the last couple of years, and I'll show you this here. Like if you look at this chart, generally in a chart that goes up like this, it pays to be bullish. You may be wrong at some periods of time, but generally it pays to be bullish. And I mean, as you know, I'm bullish now. I'm bullish that we're going to break this 68,000 in the next couple of days. I gave you guys a big thesis as to why yesterday. And I'm really bullish, and I think that it's going to happen probably this weekend. But as much as I am a long-term bull, one of my big VC friends, Avichal from Electric Capital, I sat down with him yesterday for an hour. And the one thing that I walked out of the studio and I said, and the guy said to me, well, how was the show? And I said, guys, we're not bullish enough. So today I want you guys to watch the interview that I had with Avichal yesterday. And I want you guys to really tell me at the end in the comments whether you feel the same way that I feel. Maybe we're underestimating just how big this technology is actually going to be and how big this bull market's actually going to be. That's what today's about. So before we get into it, I'm going to remind you again, you know this, but I'm going to remind you again, Friday Banters are always brought to you by NordVPN. You need to get a VPN, especially if you were part of the Fidelity hack. I don't know if you saw, Fidelity got hacked, 77,000 users doxed. That means your IP address, I mean, just look at all the stuff that they got dragged here. They got, including social security numbers, ID numbers, IP addresses, everything is now in the hands of the hackers. And that goes on to dark web, and then they're going to come and try and target you to steal your crypto. And no matter how smart or how savvy you are, you're going to get tricked at some point in time. And in fact, this week, I actually almost got tricked into clicking into a fake booking.com link. The only way to prevent that is to get yourself a VPN. So a VPN does a couple of things. The first thing is, if you go to the link below and get a VPN, click this link. The first thing that you need to do is mask your IP address. That way, the hackers and the governments don't know where to look. The next thing that and again, this costs like $3 a month. That's step one. The next thing that you need to do is you need to get threat protection and incognito. Why? Threat protection protects you against the malicious websites. And this is what actually caught the fake booking.com link that I was about to put my credit card in. It was the threat protection. And then the incognito removes your details off these bad databases, these black market databases. You've got to get the trifecta here if you want to be safe. It's $9 a month. Now, if you're contemplating around like $9, $10 a month, you shouldn't be watching the show. You shouldn't be in this industry. That's the way that I see it. Do it, guys. I say to you again, I mean, should I actually show them? Should I show them the fake booking.com link? You would never have known. I'm going to show it to you. So let me quickly get it. I'm going to just take myself off the screen. Because, you know, I know you probably think that I'm kidding about these links. Let me get a few so you can see. Let me see if it also if it exposes my email address, because I don't want you guys emailing me. I know some people here. So I get an email. Here, wait, hold on. Let me show it to you. You'll blur everything out. Okay, you promised me you're going to blur everything out, so people won't actually see it. Hold on. I'm going to get, because this is a real story. This is a real story. Literally, I got a link from booking.com after I made a booking in a hotel. I got a link and I was about to click the link and put my credit card in because they asked me to confirm my credit card details. And it came from booking.com. So it's not like a scam thing. But the threat protection picked it up. And luckily, otherwise I would have been out of money. I'm not going to show it to you because I see all my details are actually on here. Anyway, let's get straight into the show today. It does look like, as I said, it does look like this upward momentum in Bitcoin continues. I do think we are going to break out pretty soon. The question that I have though is, like, if you're a VC investor, do you actually care about 7-month movements or 6 months movements or 3 months movements in Bitcoin? Or are you looking at this as a 5-year play? So I think with that, let's get into the first question. So I'm going to bring in our guest, Avichal. Avichal, how are you, my friend?
Fantastic. Good to see you.
Good to see you again. We met in person for the first time a couple of weeks ago.
That was a blast.
Yeah, interested to understand as a VC, someone who's, has a VC thesis. Do you look at like the Bitcoin cycle and like kind of wonder, when are we going to break out? When are we going to break out? When are we going to break out? Or is that really like kind of inconsequential because you kind of know that the general trend is up? And so when we break out doesn't really matter to you. How do you guys, what's your view of the world in this regard?
A little closer to the second, but kind of a blend between the two, I would say. So obviously, by the way, we always say this, but you say it, I say it, is not financial advice.
Nothing is financial advice, just so you know, because we're going to be squeezing a lot of juice out of this lemon. And just so you know, none of it's financial advice, and all the opinions are Avichal's own opinions and not those of his company. So let's get that out the way, and then let's get straight into the alpha.
Yeah. So I think as an investor, somebody who's been in the space for a while, you can't not pay attention to the cycle. There is sort of a cyclicality to this. And that wealth effect, whether it's Bitcoins or whatever the most hated thing is, last time was NFTs, this time it might be meme coins, that wealth effect then sort of drives a lot of the activity that you see. So you can't ignore it, but you also can't be hyper focused on it, right? You can't say, hey, look, like I think it's going to break out next month, therefore I do this thing for the next 30 days. I think if you try to get to that level of micro, it's a little too hard. And so you kind of want to generally think about the long term, and that's generally how VCs have to think about it. Is we're talking, we have closed-end 10-year funds for our LPs, and so we're thinking about what happens over the next 5 to 10 years, not what happens over the next 5 to 10 weeks. And so directionally, these things moving in a certain direction is more important to us. But you do have to be cognizant of the fact that if you're in like Mega Bull 2021. That's a pretty tough time to be doing like late stage investing, right? Like everything, the valuations are all inflated. Like you're really going to eat it in the face in the next year. So you have to be really careful of what you're putting your money towards at that part of the cycle, for example.
So one of the things that I've been hearing a lot in the institutional investor circles is that the real money, or lots of big money, is sitting on the sidelines waiting for the outcome of the election. So kind of people are saying, look, before we deploy X into crypto, or before we decide whether we're going to deploy X or Y into crypto, we want to wait for the outcome of the election. I think they're talking about, probably Trump being more favorable for crypto, and Kamala potentially being, slightly less favorable for crypto. How important is the election outcome? Like really, like what do you see if we get a Kamala win? How do you see the roadmap? And if we get a Trump win, how do you see that playing out? Because you must have a thesis around this, right?
Yeah, at the highest level, I don't think it matters. Actually, I think if this were the 2020 cycle, I think it would matter a lot. 2016, it mattered a lot. But the reality is, if you look at the data, I mean, we try to be data driven about this, right? If you look at the data, it's kind of game over. Crypto won, right? Like we have a Bitcoin ETF, we have an ETH ETF in the US. Globally speaking, stable coins, there's $160 billion worth. It's going to get to $1 trillion very quickly. If you look at real usage of these things, like people trying to put their money towards productive DeFi assets, real world game, assets coming on chain. There's that game that just blew up in the Steam store on Avalanche. Like it's just a fun video game to play. It just happens to be built on crypto on the back end. Like crypto won at this point, right? So now the question really, I think, has changed, which is where will the jobs be created? Where will the economic benefit be? Which users get to use these new products? And so I think the game is actually very different today than it was even 2 or 4 years ago, because crypto won. So what does that mean? I don't think either of these guys can kill it. I don't think a President Trump or a President Harris kills crypto. I think they could slow the adoption, or they could actually accelerate the adoption, but they could do it in a healthy way or an unhealthy way, right? I think there's a risk actually. Like I think everybody's going pro-Trump, and I think he could be great for crypto. The challenge is if you sort of open the floodgates too quickly, and there aren't proper consumer protections, a lot of people could get rugged. And 50% of America, wanting to buy into a thing that they think President Trump has effectively endorsed, and then getting rugged would be terrible, right? Like you would poison the well. Like a lot of people would sort of would say, hey, this thing is a scam if they all got rugged. So we got to be a little bit careful, I think, about making sure that we don't get too over our skis. This is kind of what happens with every cycle, right? People coming out of the bear cycle are beaten down, and they want the bull cycle to come back, and then we just get too exuberant. And so we actually have to be a little bit careful, I think, of how quickly these things go.
So I mean, I guess the thesis that it doesn't really matter, but I think the market's kind of saying to you, because we've been watching the odds versus the Bitcoin chart, and like it's been really correlated to as the Trump election odds increase, so does the Bitcoin price. Do you think that's coincidental, or do you think that's happening because of the odds? Is it causality or is it coincidental? I don't know what the right terminology is, but it just feels like it's starting to be almost uncanny how the two charts are following one another.
Yeah. Well, we also have to be a little careful with any of these prediction markets in terms of, the market participants in a prediction market tend to have their own biases. So you sort of want to be cognizant of that. I don't think it's just pure correlation. Like I do think there's some causality here. Like the market participants are sort of similar across these. So I think there's some connection there. But you also have to remember markets are not efficient. And a lot of market participants are, if you know a computer science term, they're greedy algorithms, right? So they're short-term greedy. And so what that means is that what they're really looking at, in my opinion, what the market is really expressing is an opinion that if you have a President Trump, Bitcoin is probably worth a lot more in 12 months than it is today. That it does not, markets tend not to be able to express a great opinion on what are these things going to be worth in 5 years. Right. And so this is why you get stock market corrections, or this is why Warren Buffett can have a business, because if your time horizon is different than the average participant on the market, which, and that average market participant's time horizon is relatively short, then there's actually a pricing mismatch. Right. And so I think you could argue that actually what the market is saying is President Trump would be better short term for crypto. But I think it's very hard for the market to express an opinion about which of these two folks might be better for crypto in the medium term. I'm not saying Harris would be better. I'm not saying Trump would be better. I'm just making an observation about how markets express these things.
But you agree that if Kamala Harris wins in the short term, potentially it's going to be not as good for Bitcoin than if Trump wins. I mean, I guess that's what the market's telling you in the short term.
I think that's what the market is saying in the short term, is that a President Trump is more likely to be able to create movement there, and is going to be more overtly pro. But again, I think we have to think through second order consequences. This is one of the hardest things is, that could be great. And then what happens if 50 million Americans, go through a full cycle with meme coins and they all get rugged? Like, it's not clear to me that's a good outcome 3 years from now or 4 years from now. Right.
Okay.
Like that might be like a 5-year bear market, because the entire population of people that bought in just all, goes to zero and gets rugged. That could be terrible too. Right.
So, okay. So, I mean, you went there. I wasn't going to go there that quickly, but I mean, you went there. You chose violence. So let's go there. You chose violence. Meme coins, 32% of the attention so far. Maybe even higher than that. Walk me through your thoughts on meme coins. I mean, I guess that it's definitely a retail game. Do you think do you think there's any world where reputable VC funds start investing en masse in meme coins? Or do you think that it's like, as a VC, you guys are VCs, and I know we get the hypesters on Twitter that say, VC funds are allocating to these meme coins. Is there a world where I'm sure a VC fund or two VC funds can allocate into meme coins, but is there a world where funds really start investing in meme coins?
No, short answer. Yeah, no.
Tell me why not.
I think it's going to stay. Well, it's, our mandate is different. What we're trying to do is find like proper institutional VCs. Like the problem with VC is anybody can call themselves a VC, right? Yes. I can get a couple $1 million in a pool, and it can be mostly my money and my friend's money, and now I'm a VC. But a proper VC that has, U.S. university endowments, large nonprofits, large foundations, where you want to be a really good steward of these people's capital, like the people who give us money, if we make money for them and they get money back, like kids go to college for free, there are a bunch of scholarships, like people get free cancer care, like a bunch of good stuff happens, right? So when you're a steward of institutional capital like that, the mandate that you have is you're trying to find productive assets. And the challenge with the meme coin stuff is it's not a value judgment, but I don't think they're productive assets. Like they don't lead to some sort of economic activity downstream that is non-zero sum, which then, results in cash flow, and then you can value that cash flow. And so it's very hard, I think, for institutional VCs to be able to invest in meme coins directly. Now, I think there are places where institutional investors could be investors and have exposure to that part of the sector. So, for example, if you're an investor in a crypto exchange, almost certainly you're going to benefit from meme coins, right? And there's a lot of other activity that happens on those exchanges, which is productive economic activity, like Bitcoin or Ethereum. And so I think that the institutional dollars will actually flow into some of these other channels. They won't go to meme coins directly.
So how do you view the meme coin? How do you view the meme coin cycle? I mean, as a company, are you placing bets around the infrastructure that is not the meme coins themselves? But I know you're not placing bets on the meme coins themselves. But are you placing bets on the decentralized exchanges? Are you placing bets on the token launch platforms and stuff like that? And also, how long do you see the meme coin craze actually lasting? Is this a 3-month thing, a 6-month thing? Is this a whole cycle? Are we going to be here in 2029 and people are still launching meme coins on pump.fun after every word that everyone says? Like, how do you view it from a VC investor point of view?
Yeah, I mean, we are investors in a number of exchanges and sort of platforms, and so we sort of get exposure that way. And I think it's it kind of goes back to this. So much of this is sort of understanding markets, right? And so if you have an opinion about what people should do with technology, you're probably not going to make great investment decisions. Like, markets tend to be really messy, and people will take these technologies and do things with them that you may not like. It's sort of, it sits kind of next to like free speech or freedom of thought, right? People are going to do things with technology that you may not anticipate or you may not like, and that's okay. And so as a good investor, what we think about is, how do we get exposure to whatever economic activity is happening? And hopefully a lot of it is productive and not zero sum, but it's actually additive to the world. And some of it's going to be, zero sum, and that's okay. That's the stock market too, right? There's a bunch of high frequency stuff that's happening. It's unclear if it's actually zero sum or net negative. And that's just how markets are. And so you sort of have to eat the cost of these sorts of activities in some sense that are not necessarily productive in order to get the productive stuff. And so that's how we generally get exposure. Are these things going to stick around forever? I mean, I'm kind of curious how you think about it, because I think you have a good intuition for this. But the way we think about it is, to us, it feels like a game, and it's
exactly
an outlet. It's an outlet for people to have fun. And I think fun is one of those things that, how do you put a number on that, right? Is that productive or not productive? Like, humans like to play games, and so that's going to happen, and that's probably going to happen a lot. And it just happens to be a type of game that a lot of people think is speculative or not.
Can I challenge you on something?
Yeah.
If I look at the stock market, some of the stocks are trading at PEs of 400 and 300 and 150. I mean, one could argue that those are actually just attention coins, and like every stock is actually just an attention coin, and investors justify to themselves a valuation. Right now, I mean, I was where I learned this was, I was an IT analyst in 1998. I was a IT sector analyst in the stock market in 1998, believe it or not. And that was when the big 2001 bubble was in the making. And I was building models to justify the valuations of high-tech companies. And I remember that when your model didn't match the number, all you did was change your model, change your risk parameters, increase your number of users to kind of make it more or less in terms of the number. And that's, I think, where I learned that really every stock valuation, barring stocks that are high cash flowing stocks with low PEs, is actually a meme, right? And so the way I see it is, the casino is a stock market. The stock market is a casino. And we justify the fact that we're playing in the casino with the fact that it's actually justified by earnings. But in most cases, I think everyone knows that the earnings will never, ever, ever justify the stock price, right? Like Nvidia's, if you look at Nvidia's stock price and you look at Nvidia's earnings, the two can never, ever, ever correlate. Like, yes, we can do it. Just plug in insert PE, right? And so the way that I see meme coins is, it's the same thing. It's the same thing. It's just without the backing of the earnings, which actually are in 80% of cases kind of inconsequential. And I think what we've created is, we've just created this massive casino, which is a global casino, where you can go at any time of day or night, and you can go and put a small bet on where you think the attention is going to go next. And who cares? And then the idea is to see whether or not you can determine where the attention is going. And that's the massive casino we've created. And So the way that I look at it is, I think we've actually created probably the biggest casino in the world. I think we're bigger than Caesar's Palace. I think we're better than Wynn Resorts. I think we're bigger than we just created this massive casino where people are going to trade attention. And so we should just call it what it is. Solana has actually become the win, and the meme coins are the tables, and we should just call it what it is. And Solana should be proud to be a casino. And then that actually takes me to the bigger thesis. And my bigger thesis is, well, actually, if blockchain is about creating value.
Can I push back on one thing there?
Yeah, sure.
I think so I think I half agree with you, which is I do think there's there's this sort of framing that people talk about in crypto, which is this a computer or is this a casino? And I think it's both, right? I think the casino aspects of this fuel the computer aspects of this. So you're talking about 98, right? That was really a telco bubble, if you look at it, right? It was things like Cisco, Juniper Networks, right? There's a lot of AT&T, Verizon, these kinds of things. And what was happening was there's so much speculative activity around what those things could be worth that it fueled a huge amount of investment actually into infrastructure. So the reason you could argue that downstream things like Netflix or Amazon or we got high-speed broadband, which allowed you to have YouTube. All of these things actually came because of the overinvestment of the speculative cycle. There's an economist by the name of 𝗙𝗢𝗡𝗧 that everybody should go read. And this is basically her fundamental theory about markets, which is that this is just a property of markets. So you sort of need the speculative stuff in order to get enough overinvestment into the infrastructure to do the non-speculative stuff. So
I think the theory is that she says in the book that the speculation is around overinvestment into a certain sector, and then you get underinvestment into the sector. But the overinvestment is actually what fuels the innovation in a because that fuels 100 projects. It allows you to sort of
exactly. It allows you to get over this hump of if somebody had said to you in 2016, we're going to invent these giant distributed systems with data layers that you can read from and trust systems like EigenLayer and execution layers like these L2s that we have and something like Solana, I don't think you could have raised billions of dollars from VCs, traditionally, or from Wall Street to go pursue these things. So you kind of had this speculative cycle that's fueled it all. And so I think I sort of half agree in that there is this casino aspect to it, but I think that I tend to believe that you're going to get the overinvestment, which then fuels the computer part of it, right? And so the casino precedes the computer.
Let me finish the thesis. So my idea is that we've created a massive casino in memes, right? But then my thesis is actually that memes are the first game in the casino, being say the blackjack or the slots or the roulette or whatever else. But ultimately, this whole industry is actually about creating value where it didn't really exist and being able to trade the value, which means that the rails that we're building for meme coins actually hold true for any other application of what this technology is. Meme coins is just a way to stress test it's the first stress test that we've had of this technology, where retail is coming in and buying into hot air, which is value created out of thin air, which is exactly what blockchain is. It's the ability to create digital value, incremental digital value where it didn't actually exist, or to bring Web 2 digital value onto chain. And then the ability to trade it. And then what you got to ask yourself is, where's the value going to be created and who's going to trade it? And that's why, for me, my thesis in terms of investing is always the L1 and the DEXs. The L1 and the casino. The L1 being the rails and the casino being the DEXs, and even better, the perpetuals DEXs, because DEXs are cool for transferring value. Perpetuals are cool for driving leverage value, which is much more fun than playing the value game. Which I
think that's a really interesting thesis. And you know what? It goes back to kind of what you're talking about with the 98 stuff, which is I think it's an interesting question of what percentage of the market at any given time, the stock, let's say the US equities, right? Stock market is actually the casino versus the productive stuff. And if you go back to, let's say 98, 2000, 2001 crash, 2005, roughly IPO of Google, you could have picked off Amazon in that window. Right. And Amazon's PEs have been very, very high for a long time. And here it is as a $1 trillion plus company. Google, you could have picked off. Facebook, you could have picked off at IPO. Right. And so it's not that everything is in the casino bucket. There are real productive things that were happening in, anywhere from 95 to 2005 that you could have participated in. It's just that everything was being valued like it was going to be the next Amazon. Right. And so that's the challenge, is which of these things is actually going to be durable and real and productive. And I think if you can actually get into that mindset, which is, look, okay, most of the stuff that was happening in the 90s was basically meme coins. But I'm going to try to find the ones that are not, and I'm willing to hold for 10 years. That's where you picked off Amazon, right? That's where you could pick up PayPal. That's where you could pick up Google. Google IPO'd in 2005, but I think that's the mindset, right? And so I agree with you. I think that fundamental question of, if you think the casino is what draws a bunch of capital and people in, but there is real fundamental value being created, the question then you have to be asking as a long-term minded person is, where is the value ultimately get captured and created?
Yeah. So again, the way that I look at it is, I look at all blockchain investing like investing in a casino, because ultimately I think that's all we're creating here. We're creating rails to transfer value, and wherever humans have created value, they've also created speculation rails on that value.
Yes.
So you think about gold, they created the gold exchanges. That you could think about when they created stocks and shares or fractional ownerization of companies. They then created the trading platforms, and then they created the gambling platforms, which is the derivatives trading platforms, the leverage trading platforms, and the options and the futures and whatever
the derivatives. You could argue the derivatives platforms are also, potentially they do have some amount of speculative activity, but a lot of those markets also are very productive, useful financial products, right? If you're a commodities producer, you need to use futures and options to hedge out your exposure, right? Like,
Correct.
You need to know that you can pay your bills, right? And so that's where I think I go to this question of, I don't know what the answer is, but I think I might be on the side of it, which is that the speculative stuff bootstraps this infrastructure. Once you get the infrastructure, you see this gradual evolution away from the speculative stuff, where yes, the speculative stuff is still there, but there's so much economic value to be created using these, just look at the stock market, right? Like, what percentage of the stock market is in the companies that actually create real value, right? Even beyond the Mag 7.
Don't look at it in the stock market. Look at the value of the financial system that is created around stock market companies. And when I say that, look at the stock market is one layer of value around companies, right? Stock market is effectively fractionalized ownership of companies. But then you have another layer of it, which is the speculation and hedging. So I'm going to call that betting. So speculation and hedging around the price of companies. And that brings you into derivatives, which is options, futures, any kind of derivative layer, right? And that you can say is not value that is created by the company, but it's the value that is created by the betting around what that company will do or what that commodity will do. So you said around hedging. Hedging is just betting to reduce your risk. So you could either take the risk of holding coal, or you can do a bet and cash out of your bet and let other people bet that it's going to go up or down. So it's just feeding a betting market. So my thesis, after having thought about this long and hard, is all we're building here is we're building the way to transfer, to create or migrate, and then swap. In other words, trade between me and you, and speculate. And speculate can mean value. Speculate can mean reverse speculator bet. Now, with that in mind, my thesis was to say, okay, well, if that's the thesis, then invest in all the L1s that you think are going to house the transactions that can capture economic value, because it will be able to somehow capture the MEV or the economic value, number one. And number two, invest in anything that has a chance of being trading, spot, derivatives, speculation, and everything else, in my opinion, is actually too high risk, because then what you're actually betting on is you're betting on individuals, and I'm not really a good person to bet on individuals. I'd rather just bet in those two narratives and stay out of everything else.
Yeah, it's not crazy. I mean, it's almost a picks and shovels. Like, there is going to be value in roughly this sector. It's kind of like in AI. Do you want to try to pick off the companies that are going to be the customer support AI winning company, or do you just want to buy some NVIDIA and TSMC, right? Like, no matter what happens, they'll do great. It's a very reasonable, I think, way to look at it. What do you make of then? How do you think about with that L1 thesis? How do you think about like the L2 debate that's happening right now, where like Uni is going to move to Unichain, and if they take all the fees up and ETH isn't getting any fees and so on, like, how do you think about that?
So I'm glad you brought it up. So I read the Andreessen report. One of the things in the Andreessen report is, I know that this correlates to the report that you guys write, which is the Builders report. Yeah. I was kind of shocked to see this. So some things here actually made a lot of sense to me. The first thing that made sense was that the Solana developer activity doubled. And that was, for me, like, really good. What I was quite surprised about was that there was 20% of the builders mindset, or the builders mind share, is on ETH still. And I kind of thought, okay, but what are these guys building on ETH? Because I haven't seen anything launch on ETH. Like the only thing I've seen launch on ETH is L2s. And I'm starting to look. I've been quite vocal about it. That I'm more and more falling out of love with ETH, and more I'm kind of saying, look, why do I want to be involved in an ecosystem that all it has is legacy? And the people that are building, as far as I understand, all they're building is L2s. Like other than Eigen, which to me was like a wow, like something new, restaking and stuff like that. Like, what are the people on ETH actually building again? Remind me. Like, they seem to just be building L2s, and they seem to just be building something that already exists in a lot of L1s, like Near, like Solana, like Sui. Like, you got all these great blockchains that have so much throughput and such low fees. I struggle to understand why 60% of the mind share is still on ETH. When I say 60, 20% here is on ETH, then there's 6% on Optimism. So I'm just like, what? Where is this mind share all going? Maybe you're better versed to answer that, because this is your area of like, this is where I know you guys focus a lot of your time.
Yeah, we're actually, so first, props to the A16Z crypto team, Eddie and team, 𝗙𝗢𝗟𝗟𝗡𝗧, the CTO over there. They did a fantastic job. We know firsthand how hard it is to get any kind of data in this space. Yeah, technically it's open source, but like actually collating and collecting it and scrubbing it is a real pain in the butt. So props to those guys for shipping this. What I think is interesting specifically about this one that you have put up right now is, you know, the question I have, because this looks like survey data, and what it makes me wonder is there like a little bit of a bias in the answer, which is when people say Ethereum, do they actually mean Ethereum L1? Right? Or are they saying Ethereum ecosystem? Because a lot of times if you talk to developers, they'll say, I'm building in Ethereum. But what they're really saying is like, oh, I'm launching my DEX on Blast and on Base. I just happen to be using an EVM, and I'm using Solidity, and I'm using Foundry. And you know, the tool set is all Ethereum ecosystem. And so it kind of makes me wonder if when people say Ethereum, what they're really saying is sort of EVM ecosystem, and they just happen to call it Ethereum. And so I don't know the answer to that, but that would be one explanation for kind of what's happening. To your question, I think there is actually something very fundamental happening in ETH, which is very important. And I tend to think that the market, you know, in the narrative cycles, you know, it's sort of gotten beaten down a little bit and gotten lost. But you know, other than Bitcoin, ETH is the only thing that has regulatory clarity in the United States. It has an ETF that's been declared a commodity. It is a tremendously it's an amazing accomplishment to have built a distributed system that nobody owns or controls, that anybody can write code to, that's, you know, permissionless and censorship resistant. I don't know what that's worth, so that's not an economic argument. I think it's a technical argument, right? Which is, it's amazing and remarkable that we built this kind of a system that a bunch of open source people are upgrading, and we moved from proof of work to proof of stake, that these L2s have one.
I thought about that. I thought about that, and I thought about that actually in context of the next slide, which I'll show you over here, right? Which is somewhere here. They talk about the ETF approval, and they talk about the fact that Bitcoin's got $58 billion in total on-chain holdings, and ETH has 7. And I saw some people on Twitter saying, hold on a second, if you take the fact that Bitcoin has 4.5 times ETH market cap, then you say that number on a regular basis should be 30 million. And then you say, well, hold on, the ETFs are 7 months apart. Actually, ETH's not doing that badly. So I did think about that. Yeah. But
well, and in the history of ETF, so people forget how remarkable it is it got to 7 billion so quickly. You know, like it's pretty rare that you have ETFs that get north of $1 billion in their first 3 months. It's a very, very rare accomplishment actually in the history of ETFs.
So I thought about the regulatory clarity thing, and I think you're right that we have regulatory clarity on ETH because we've got an ETF, and the same thing on Bitcoin because we have an ETF. But anyone building a project on top of ETH doesn't have regulatory clarity as to whether what they're building is actually, in fact, anything that has been built on top of ETH so far has been deemed with a token has been deemed to be a security. And so, you know, great that the base layer has been deemed not a security and regulatory clarity. The second thing is,
well, but it's not the regulatory clarity that I think is the important bit there. I think it's the reason we have regulatory clarity is because what even the U.S. government has been forced to admit, which is a very high bar, right, is that thing is sufficiently decentralized such that it's a commodity, that nobody controls it. And therefore, what you have is a censorship-resistant, seizure-resistant, decentralized, permissionless system, which is a computing system, right? And that is a remarkable accomplishment. Again, I'm not saying it's worth $1 trillion or $10 trillion or zero. I think that is a remarkable accomplishment.
What
that
other
I don't think the
blockchains?
market has quite gotten its head around.
What other blockchains? Forget about a regulatory point of view. Let's talk about a logic point of view or a reality point of view. What other blockchains do you believe are sufficiently decentralized that they are really will decentralize supercomputers? You can't deny that Bitcoin is. You probably can't deny that Ethereum is. How do you rank Solana? Is Solana really a decentralized world supercomputer, or is it a Solana Foundation and Anatoly and Raj project?
Yeah, I think it's pretty close. I think if you look at developer activity, if you look at distribution of nodes, if you look at where those things are running, if you look at what you have to do to actually upgrade these things, I think Solana, Cosmos, Near, arguably Avalanche, and then I think you have some of these emerging ones like 𝗬𝗢𝗄 and Aptos. Like if you start looking at that next tier down, I think it's an interesting question, and this is actually an open question we have that we've thought about, is are these things today as decentralized and permissionless as Ethereum was in 2018 when the US government, the SEC, Bill Hinman made that speech that said ETH is a commodity? And I think there's an argument that you could make that that's true. They have a similar-ish number of developers. The node distribution is similar. They're permissionless.
We were both there, and I can attest that when I was in Solana Breakpoint now, it was copy-paste of ETH in Osaka in Japan.
It felt really similar.
It's the
Very
same.
similar.
It's the same.
Yeah, it's like who? Yeah, I mean, like the critical question there is like, well, who's doing the work? And it's like not clear, right? It's like, who would you, if somebody were to take somebody out or somebody were to get hit by a bus, does the thing stop? No, it just keeps going. And like, it's you look at the variety and diversity of people that were on stage. You look at the diversity of people building stuff in the ecosystem, multiple clients. It's pretty remarkable, actually. And it very much felt sort of, and I think you make a similar case for Near. I think you can make a similar case for Avalanche. Like if you go to these conferences and you talk to the developers, there's thousands of people that are showing up to these things, and if the people who started it got hit by a bus, it doesn't matter. Like it's and it's not like one person driving it anymore.
I would argue the following: if something happened to Anatoly, nothing would happen to Solana. I think Solana. I think right now, I mean, having seen the brain power at Solana DevCon, I think very, 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 very like you can't say that Solana is now reliant on Anatoly. I think
it's become its own. Yeah. It's bigger than Anatoly and Raj at this point. Yeah, I totally agree.
I think that the smaller languages, the newer move languages, so 𝗬𝗢𝗄, Aptos particularly, are still very reliant on their tech teams. I think that 𝗬𝗢𝗄 specifically is very reliant on Sam, and I think that Aptos is probably reliant on their tech teams. But that's normal because they knew.
Yeah.
Near is an interesting one for me, and I mean I know we're both invested in Near, so maybe let's have a heart to heart here. So, listen, Ilya is a beast.
He's a beast, yeah.
Near is still Ilya's blockchain, and I think that if Ilya wasn't around, I think Near would have half the share of mind. But I have a problem with Near, and I'm going to be frank. Like I have it, and I'm a big fan. But Near launched more or less at the time where Solana launched. Like I remember that was the 2 new blockchains and the 2 new shiny objects, and I look at what like Solana's managed to achieve, and when I say managed to achieve, I mean, look at the ecosystem that's building. Look at the dApps that are being built on the chain, et cetera, et cetera. And then I look at Near. And, the token releases, both of them have had like quite large token releases. In fact, maybe arguably, I don't know the exact numbers, but I think maybe Near's had more tokens released. And I just feel that Near has got amazing technology. They've got the sharding. They got a very fast blockchain. The blockchain works really well, but zero adoption. Like I know they've got Sweatcoin, and I know, but I'm kind of looking at this and I'm going, hold on, like, am I emotionally attached to my Near protocol investment, or are they actually going to get real world adoption? I want to think that I'm not emotionally attached, but when I look at the stats, I don't see any amazing people. I don't see VC deals coming to me on Near protocol. I don't see, I just see TPS through these things. And I know that you can't trust the TPS. You need to go do it. I wonder like how you feel about it. And I know that they're an investment company of yours, but that's the reason I bring it up, because I'm also invested in it. I really want to understand like how you view this. About it.
Yeah. So a couple of things. So I think specifically if we talk about Near, if you pull up the Andreessen report, actually I think Near, other than Solana, there's a graph in there that had them in terms of like user accounts per per chain.
Yes.
And you see if you can find it. And
Yeah.
I think, yeah, that one, right? So if you look at the active addresses, in terms of what's actually happening on chain, I think Near, their approach was, in essence, it was build ETH 2.0, right? Build the sharding, build the new proof of stake consensus algorithm. Like they kind of built all the things that Ethereum has taken much longer to build. And hence they have apps like 𝗙𝗢𝗥𝗢𝗡 and 𝗬𝗢𝗡𝗏. And if you just go to 𝗙𝗢𝗟𝗡𝗏, you can look at of the apps that actually have real world usage with real users, because they have to be downloaded in the app store and like you have to create an account. Near, I think, has actually done a pretty decent job on that. Now, I think the place where they haven't done as well, of course, is in crypto Twitter and sort of the kinds of core things that people think about as crypto today. And so, for example, their DeFi ecosystem is not anywhere nearly as robust as Solana's. And so I think a lot of crypto insiders look at that ecosystem and they don't really understand it. But if you go by user accounts on chain, if you go look at 𝗙𝗢𝗟𝗏, if you go look at the app store, and I think for what it's worth, like Avalanche suffers from this a little bit as well, right? It's just like that video game that we were talking about.
Off the grid, yeah.
Yeah, it's crushing. But how many people on crypto Twitter are going to play that, and how much Twitter love is that thing going to get? Like the Steam gamer ecosystem is just a totally different ecosystem, right? So yeah, let's look at hot protocol. In terms of number, that's a wallet that's built on Near. If you scroll down.
Yeah, I'm gonna go to Near and just go to.
Well, if you just look at the top charts, you can kind of see how these things are doing, right?
Okay,
in terms of.
Hold on, that brings me to my next question. So Near's positioned itself as a now they've come out with as an AI chain.
This is gonna be my second point, I think, which is, I think one of the, setting aside Near for a second, I think this is true for most ecosystems. I think this is going to be true for Avalanche, Near, Monad, anybody in crypto. It's also going to be true generally. So this is just startup advice, right? I think the thing that Solana really crushed, that Anatoly and Raj intuitively, or they fell into, really got right, was they said, we have a very different fundamental philosophical worldview. And they said the ETH people will believe in this sort of sharding, L2, DA, we're going to build a modular stack. And that's BS. We're going to go do this other thing. We're going to have everything in the L1 because you get composability, you get throughput, and the way to scale it is with hardware. And there's a very opinionated way to approach solving the problem, right? The blockchain trilemma. And I think there's a lesson in there from a startup lens, which is that a very, very clear differentiation, which then feeds into who are your users, what is your go-to-market, how do you build an ecosystem, all these kinds of things, is so important. So in addition to the technology, I think having an opinion about why the technology needs to be a certain way downstream leads to these sorts of ecosystem effects. And I think that's what Near, Avalanche, some of these other L1s really have to be mindful of, which is if you look a lot like ETH, even if you're technically better, it's hard for people to get their head around, why should I care, right? It's hard to create mental space there. And so just doing something fundamentally so different makes it easier for the end user, whether that's a developer and end user, to get their head around why this thing is interesting or different. And that allows you to build a community and an ecosystem. And I think that's where the AI stuff is interesting, right?
Yeah, so
I think that's what they figured out in the last 12 months.
So do you think that in this cycle we'll see some AI applications being built on Near? Because I want to believe that, and I know that Ilya is an AI guy naturally. That's his natural place. And I know he's, that's where he came from. But people may not realize this, but Ilya is one of the authors on the Attention is All You Need paper, which created transformers, which is the basis for large language models like ChatGPT. Like he's literally one of the inventors of this field. Like he's a legitimate genius on this stuff. So let me actually like, if you were an investor today and you didn't have investments in either of these, and you had Solana trading at an 88 billion fully diluted valuation, and you had Near trading at a $6 billion fully dilution, like, do you think that Near is 6-7% the value of Solana? Do you think that's fair value? Or do you think
I can't comment on actual value, obviously, but the way it kind of goes back to what you were talking about before, the L1s, right? If you believe that there are going to be lots of L1s because the way that you write code needs to be an expression of what the technology underneath you lets you do, we tend to think that there's going to be multiple L1s and multiple L1 ecosystems that solve lots of problems, right? Just like there isn't one database or there isn't one programming language, like the expression of these things and how developers choose to use them has community network effects, has regional network effects, has regulatory network effects. And so if it turns out that all of the AI, let's just use Near as an example, if all of the AI developers say, yeah, there is a need for these AI to talk to each other, there is a need for the AI to exchange value with each other, there is a need for us to have distributed GPU marketplaces, all these things are a real need, it feels natural to me that the community that they would feel most comfortable in would be a community where there are a bunch of other such developers, and so you might get network effects there. And that's kind of what you see with Solana and DeFi, right? It's like or meme coins, right? It's just like you get these network effects, and if you think that these network effects are sufficiently distinct across different ecosystems, then you could have lots of L1s that coexist. If you have lots of L1s that coexist, then you can go do the math on what you think those things might be worth. That's a personal decision. But that's how we think about it. Is we tend to think lots of L1s will coexist.
Okay, so in a world where lots of L1s coexist, let's talk about some potential winners. So I think we both agree that Solana is a potential winner. How do you feel about ETH? Do you feel that ETH survives? You think
our heuristic on this is pretty simple, actually, and this is why we do the developer report every year. So literally people can just go to developerreport.com and see all the data that we see. Actually, not all the data, but a lot of the data that we see. It's just because some of it's nitty gritty and it would be hard to explain in simple graphs. But we publish all this data because we think that this is one of the best ways to understand what's happening fundamentally. It goes back to this time horizon question, right? If you're thinking about these things on a 3 or 6 month time horizon, you start thinking about prices and token prices. If you think about these things on a 10-year time horizon, if you scroll down even on that, this is the one from last year. We're working on the one for this year. But if you go look at any of these graphs around Ethereum, they're just so far ahead of the Ethereum ecosystem, right? And if you go back to Explore, the main page there,
how much of your investment thesis is based on this data? Like how much of your investment thesis is, hey, there's developers on the chain, therefore let's allocate?
A non-trivial percentage. Like it's a pretty important input for us. And the reason is that the way we think about it. So if you scroll down, keep scrolling. Yeah, you can look at the top ecosystems. Just look at the total number of developers, right? Like Ethereum is just crushing. Base is an L2 on top of Ethereum. You get Polygon, Polkadot, Arbitrum again, and ETH L2, Cosmos, Solana, Scroll, BNB chain, BNB and Avalanche, Optimism. These are all EVMs, Celos and EVM, right? Like you start looking at that and you say, wow, this is like tens of thousands, and this is only open source, right? So this isn't even closed source developers, which is the people working at Binance or Anchorage or Coinbase working on systems around this stuff. And so again, I don't know what this stuff is ultimately worth, but our mindset is that if you're a developer, right? Think about the developer mindset versus the trader mindset. If you're a trader, you buy some meme coins or you buy some ETH or whatever, and you're unhappy with it, you unwind the trade. You're like, whatever, I lost my 20%, I'm out. If you're a developer and you decide to spend a year of your life on this, and now it's on your LinkedIn profile, and you just spend a year getting up to speed on the technology, and everybody around you, just suffer through a bear market, and you're like, wait a second, we're on the cusp of a new. Do you want to unwind that? Like that's a brutal thing to unwind from a career position, right? And so what we tend to see is that the good people who come in, they kind of get orange pilled or they get purple pilled or whatever, and then they tend to want to stick around. And so there's a lot of graphs actually in our report that show things like full-time developers being sticky.
I remember that.
And so we tend to think that if that's true, what you're really getting back to the sort of market signal thing we were talking about before, the strongest possible market signal is where people are willing to invest their time, because time is so much more valuable than money. Like unwinding a trade is easy. Unwinding a career decision is hard. And so when you look at where people are investing their time and their careers, I look at that and I'm like, man, the ETH ecosystem is pretty remarkable in that way, as is the Solana ecosystem, as is the Cosmos ecosystem, right? You look at those and you say, wow, it's thousands and thousands of people a month are choosing to do this. That's a pretty crazy thing. I mean, to put it in context, these are like, if you had 10, 20, 30,000 developers, this is like a top 10 internet company, right? Like Facebook has 40,000 developers, right? Like that's a lot of people doing a lot of damage every month.
So ETH, very bullish on ETH. Solana, I know you're bullish on Solana because that's where we met. We met at Solana DevCon. Sounds like you're super bullish on Near. How bullish are you on derivatives of Solana, which is derivatives of Rust, which is Move? So it's 𝗬𝗢𝗄𝗧. Like how bullish are you on those chains?
Yeah, again, can't comment bullish, bearish on prices and stuff, but I continue to think that we have, there's one thing that it's always a little risky to reason by analogy. I'll channel my inner Kyle. So let's not reason by analogy, but understanding history can be a little valuable, right? So look at social networks, right? In 2005, you had MySpace with 80 million users,
Yeah.
right? And they got to 80 million users. They were worth like $1 billion, right? 750 million was the acquisition, something like that. And Facebook came along and started with 0, and they started growing like crazy. And if you fast forward 10 years, not only do you have Facebook at 1 billion users, but you have Instagram, you have WhatsApp, you have TikTok, you have Telegram, you have Weibo, you have KakaoTalk, right? You start looking, you have 𝗕𝗥𝗢𝗡𝗧, like you start looking around the world and you're like, holy moly, not only was there one giant thing with network effects that got to 2 billion users, you got all of these other things with a power law that also ended up with hundreds, 1 billion to hundreds of millions of users. And so these things, I think these markets, when you put stuff on a phone, right, and there's 5 billion mobile devices in the world, I think it's really hard for humans to get their head around like what the consequences of that are. And I think you get total addressable markets that the numbers, it's just funny money, right? It's just like, there's another good example here that I always use is if you look at Uber, right? Uber, when they were raising their Series A, the criticism was, well, how could you possibly be worth a couple $1 billion? The entire taxi industry is worth $10 billion. Are you going to be worth more than the entire taxi industry? And here we are, and Uber is worth 10x more. They're worth $100 billion. They're worth 10x the US taxi industry, right? And it's because when you put things on a phone and you can give it to 5 billion people, I think you get massive market expansion.
You've just convinced me to maybe look at adding to my investment in Telegram, in Ton. I mean, when you talk about putting it on the phone, you're talking about 1 billion people who potentially could use the blockchain on Ton. And I think that's...
We're so early, right? We're so early. The fact that we can even know all the projects that are happening in this space, this is, to your earlier analogy, we're in like 1995, right? And think about how much the internet grew between 95 or 98 and 2008 or 2018. So we're just scratching the surface of how big some of these ecosystems will be. Now, I'll also say, I think that, the reason this happens, there's a really important reason this happens actually, which is we're all still primate brains. We're still a bunch of monkeys, right? And so like, think about the biases that our brains have. Like if I show you this, you're like, okay, this is 5. You can see this number is 5. If I showed you a pile of bananas, you don't know if it's 30 or 50 or 100, right? That's why they do those like jelly bean counter games, right? It's like how many beans are in it, because we can't do that. And if I showed you 1 million, you would have no idea if it's 1 million or 10 million. And so these large numbers are very hard for us to understand. We're very bad at low probability events, right? Like what is the chance that you die in a plane crash versus a car crash? People are scared of flying. They're not scared of dying in a car crash, right? They don't understand these low probability events. We don't understand hypergrowth, right? Look at COVID. People just didn't understand the consequences of exponential growth over short periods of time. And if you think about what startups are, it's actually the intersection of all 3 of those things. You're talking about billions of users, a low probability of success, and crazy exponential growth over 10 or 20 years. And so you're literally like this sort of thinking that we're talking about here with markets and investing. And what makes the VC job so hard is it's the intersection of 3 fundamental biases all put together. And so it's a really, really hard thing to reason about. And so you have to like really overcorrect for those biases, I think, to even have a good starting point for how to think about these things.
So I think what I'm hearing you saying is that we're thinking too linearly and too small,
Correct.
Given the effects of what this technology will have. So I think what I think that it reminds me of the paper when I was a stock market analyst. It was when internet was launching, and people thought that the paper mills would actually die because internet was launching. And I remember that the paper shares actually went down in South Africa. South Africa is a big paper manufacturing country. And I remember that they thought the paper mills would die down. But what actually created is because the internet, we just couldn't fathom how big the internet was actually going to be. It wasn't part of our subset of considerations to realize that not only is it going to be so much bigger than the paper industry, but it would actually have a positive effect in the paper industry. And I think what's happening here is, again, the one was a move to digital data sent around the world at the speed of internet. And now it's digital value sent around the world at the speed of internet. I don't think that we can fathom I think what you're saying is we can't fathom the effects that that's going to have. And we think we can, but we can't because we don't actually have a frame of reference in our brain.
We don't. And you're hitting on like 3 or 4 really important things here that I think are maybe worth highlighting if people want to go, think about these. I don't want to take credit for this idea. I think it was 𝗥𝗢𝗡, but I also don't want to misquote him in case it wasn't him. But your exponential thing is exactly right. If you think about the history of technology for the last 50 years with information technologies, at every point in that curve in 1980, 1985, and 1990, and 1995, if you stood on a point in time and you look backwards, what you would say is, wow, it's been exponential. That's crazy. And then you look forward, and if you extrapolate exponentially, you sound like a fucking crazy person. You're like, really? Like, there's going to be a computer on every desktop. There's going to be a supercomputer in my pocket, right? And so you'd sound like a crazy person if you extrapolate exponentially. But it turns out at every point in time, 1990, 1995, 2000, 2005, 2010, 2015, at every point in time, the right answer was to extrapolate exponentially, not linearly, right? So that's one. Two, the thing that you just highlighted with the paper mills or paper or information technology in general, there's this paradox in economics called Jevons paradox, I think. And essentially what it says is that when you reduce the cost of some, you make something much more efficient, you actually drive up consumption of the thing. So like making energy cheaper means way more people will consume energy, and therefore the net consumption of energy will go up. And I think that's one of the drivers. You saw that with Uber, you saw that with social networks, you see that with media. And so I think a similar thing happens here, right? Like we're going to drive down the cost of exchanging value and doing business, globally speaking. And so you have to imagine that because of that observation, you're going to get so much more volume happening. And it's very, very hard for us to get our heads around that. And then the third thing, which you're hitting on too, is we are really, another bias that we have is we tend to overestimate what's possible in 2 years, and we tend to underestimate what's possible in 10 years. And it goes back to this sort of exponential linear thinking, right? It's like we expect that these things happen very quickly, and then they don't happen for 2 or 3 years and you get disillusioned. But actually it's because exponential growth is actually sublinear in the early days. And so in the early days, it is actually still exponential. It's just like we haven't sort of caught on to the fact that it's exponential, and then it just keeps going exponential. And you wake up 10 years later and you say, holy crap, all that stuff happened. So if you go back to 2018, there's so many interesting ideas in the ICO market, right? Around stable coins and DeFi and DEXs and perps and apps on chain and AI you're gonna have agents on chain doing stuff, and like all of these ideas, and they were all the right ideas, and we're only in 2024. We're at the end of 2024 right now, so we're like halfway through that 10-year cycle. And so is it crazy? Like we now can have line of sight in 24 looking to 28, and I think you can look at 28 and say, actually all those things might happen, right? Like we will actually get $1 trillion of stables, and we'll have DeFi that works, because it already works. It survived FTX and the Japanese yen crisis and SVB, and it performed flawlessly. We have all these chains. We got the execution. We moved to proof of stake. We got custody. We got ETFs. Like you look at all these things and you're like, holy moly, I think the 2-year, 10-year thing happened again. And it somehow surprised everybody again. We're going to wake up in 2028 and all of the things from 2018 are going to be true.
It's so like I'm naturally an optimist, and I can't unprogram myself, unfortunately. And it's maybe one of my biggest downfalls as in investing. I never see the bad side of things. I always see the opportunity, and I tend to not see risks. And so I consider myself extremely bullish about this industry, because even when I was younger, my grandfather used to say I had optimist disease. He used to call me, say, you got the optimist disease. You're so happy that you're always optimistic. And so I'm naturally, I think, one of the biggest bulls in this industry. And that's because I think that I always find a way to rationalize the negative news. But what you just said to me just took my optimism I just realized that I'm not bullish enough. And that is when you said earlier that in history, if you look back, exponential was obvious. And when you were sitting at that point, you couldn't look forward. I'm not trying to, in my head, like say, hold on, if this were to be exponential. And the reality is that the problem is that I just can't imagine it, because I've never had a frame of reference. Like because the nature of exponential is the next part will grow faster than the last part. Yeah. But the only frame of reference you have is how fast the last part actually grew. So it's a very big thing. So listen, on that note, because now I'm like, this is going to be bigger than I actually thought, and I've got to actually go and process it. I'm going to let you go, because I know you got an investment meeting. And we're completely out of time. It's been absolutely amazing having you. Very different type of discussion, but wow, like my mind is absolutely blown, and I'm sure that everybody else's mind's blown. So thank you very much, my friend. We'll see you soon, hopefully in person too. Thank you. And to you guys, we'll see you guys again on Sunday. Sunday, we've got another meme coin show, another fun gambling, DJ and dirty show. We'll see you guys again on Sunday. Can't wait. Until then, guys, trade well, my friends.